You know, if I had $1 million, I'd probably put a lot of it in crypto. You know what I wouldn't do? Spend 3/4 of it on mobile games. Yep, you heard that right. 750 grand on in-app purchases. It's the sort of thing you might have heard of before, either of toddlers doing it by accident or of people with maybe a little bit more money to spend than you and I. We're going to talk to one of those people in a second, though, and he thinks it's this sort of thing that could potentially guarantee the future of a brand new industry, play to earn. In fact, doing anything to earn on blockchain is really the new industry, and an idea that looks like it could be vital to the industry's future in general, and a real-world application too of this revolutionary technology of blockchain. Even amidst the bear market, the crypto winter, this part of the new economy seems to be gathering some speed. It's had its fair share of problems as well, though, so we're going to take a look at that today. We're going to ask what it's really about, what its future currently looks like, whether that's been changing at all. We've also got some interesting takes on why traditional hedge funds are finally getting into crypto. Better late than never, right? So what are their strategies for getting richer? Tell us about what's going on and about what's still to come. Matrix Port's US boss is going to explain that in just a few minutes. So, play to earn. It sounds like a dream job, really, doesn't it? Playing games, making money at the same time. Probably something countless people around the world would jump at the chance to do. The industry, it just really isn't there yet, though, is it? We know, of course, that Axie Infinity has done tremendously well. It stormed past the $4 billion in sales mark just this year, and despite losing some $650 million in the Ronin bridge hack, as well as all the bad news that's hit the crypto industry and NFT markets, it continues to be popular. The hype around Axie, however, has died off somewhat, and attention to it has really since turned to what could be next in the play-to-earn arena. In fact, that's come to be called now the X-to-earn, doing lots of different things offered on the new economy, rewards for everything from running to reading, and big names are keen to get on board with this. There's already large brands like sporting manufacturer ASICS and Spanish football giants Atletico Madrid who have sealed tie-in deals with the sector. But concerns really remain about this new economy's fundamentals. So how viable, how sustainable a business model is it? Well, Forkast's Lachlan Keller is going to tell you why.
At one time, top Axie Infinity players in places like the Philippines were able to make a living from playing the game. However, the tokenomic model proved unsustainable, and paired with the bear market and slumping crypto prices, the industry has pivoted away from play-to-earn games. Brian Liu of investment fund Infinity Ventures Crypto told Forkast that developers are changing their focus as a result.
The companies that we've been seeing that are brave enough to launch are making it play and earn. So you're playing it, but it's more for fun. If you earn some, but more so, it's more fun to play. And it seems like that's the model where we're going back to right now, where you can kind of call it a more Web 2.5, where these games are fun, or people can spend or buy in it. But a lot of these you can even use fiat to do in-game purchases.
But could a killer app change things up again? Liu thinks that porting hugely popular Web 2 titles into Web 3 and allowing players to recover some of their in-game spending could be the key to allowing the industry to break through to a mainstream gaming audience.
I'll give you an example. In Game of War, which is a completely Web 2 game, we're talking about a 6-7-year-old game, Game of War. It was the highest earning ARPU game in the history of Apple App Store and Google Play Store. I spent $750,000 US playing that game. By the time I was done playing and I wanted to sell my account or sell stuff inside my account, I couldn't sell anything inside my account. If I was able to sell the gems, materials, food, gold, all this stuff that I amassed, I could have recuperated so much of that money back. And I think that will go into the mindsets of a lot of these Web 2 gamers. If they can find a way to make some money back on it, that is what's going to take Web 3 gaming to the next level. And all these Web 2 gamers that are spending billions of dollars in the industry, will be flooding into Web3.
Author Andy Leon believes it will take time for Web2 games to make the leap, as those who are comfortable with what they're already doing now are highly unlikely to change.
So I don't think the super app is coming anytime soon, but I think, to be real honest, from a technology perspective, it is easy to do. But from the revenue perspective and from the receptiveness from the different game companies and studios, they might not be agreeable to how Web3 is going to help them, since they are really making millions of dollars in revenue every year.
Leon says play to earn can work, but the games need to prioritize the play rather than the earn.
With the context that the game is good. So I still see that play to earn from a game perspective, it can grow. Let's drop XC and so forth. I hope to see better games in the space so that you can see the push and can see the growth.
In the meantime, we're seeing the rise of X to earn, where X can be pretty much any kind of activity from reading to running. But can the play to earn model be transported from gaming to other activities successfully?
Oh yes, definitely. There's a company in Korea called Synist. They are the leader in read to earn. People read, they get paid in tokens. The read to earn part, they have an AI that basically knows when you touch the screen and you're scrolling up and how fast you scroll up and how fast it takes you to read the page is really what determines if you're faking it or not. Move to earn is something that is caught on because of StepIn, for people to get in their steps. And then now they have all these other companies that are coming up. Sweat to Earn is a running app. Bike to Earn is a biking app. But then when you think about it, all these are very niche markets.
Lou compared this to the popularity of Web2 apps like Strava, which tracks physical activities and shares the info with friends. However, Leon has a warning over the economic principles behind some of these projects.
The problem with some of this X to earn model is that it seems like a really good innovation, but then it is just purely a Ponzi. Reason being is, again, it's very simple, straightforward. There is no sustainable revenue to help facilitate with the amount of earnings that they are giving out. In this scenario, X to earn, most of them do not have any form of real revenue. They might argue that, hey, Andy, we have tokenomics behind it, right? So whenever someone buy this or whenever someone do something, X amount of X percentage or X amount will then be routed to another wallet, and you can use it for marketing and so forth. But those are not pure revenue.
Lou agrees on concerns over Ponzi schemes, saying projects need to ensure that token models work.
This model of walk to earn, eat to earn, read to earn, there's always going to be people needing to support the token. The token has to have some type of utility. With StepIn, they basically partnered up with big name brands, Nike, Adidas, to offer a special edition shoes where people will be forced to spend their token. And then when that happens, it kind of becomes, well, you're not really a play to earn, it's play and earn, because people are having fun upgrading their stuff and not just earning tokens. The bubble will happen once people won't be able to, or will stop spending the tokens inside the game.
So what lessons are being learned from the shortcomings of the Axie model in terms of how to keep the cash flowing in?
I think that what these new X to earn companies that are X to earn projects that are coming up, they're going to start learning to advertise their users and their users' behavior, their users' just the user's behavior and users' data to marketing companies are willing to pay for it.
Of course, this could raise concerns over data privacy, something which Web3 has promised to safeguard. Lou says users will retain their anonymity in terms of personal information, whereas the data that will be used here is just numbers. I'm Lachlan Keller, Forkast.
Now, seeking alpha is very much a maxim for investing, really, isn't it? Basically, it means looking for an edge, for that information, that little bit of knowledge that's going to give you an advantage in trying to beat the market. It also sort of sounds a little bit like a Pixar movie for hedge funds, doesn't it? Well, according to PwC, if it was, that movie would need to include crypto in there somewhere. A new report says that traditional hedge funds are making bigger and bigger bets on blockchain. Crypto-specific hedge funds, meanwhile, are getting better at making their own bets as well. Why? Well, Anthony DeMartino, CEO of Matrixport, is going to help us try and understand that a little bit. So let's talk to him now. Anthony, thanks for chatting to us. Listen, the consensus of this PwC report seems to be that crypto exposure is growing at traditional hedge funds. 1 in 3 now investing in crypto compared to 1 in 5 a year ago. What do you make of that? What do you think is likely behind that sort of growth?
I mean, when you look at the volatility and price appreciation, the bifurcation of markets and the inefficiencies, these are just absolute super attractive items for hedge funds to try to take advantage of. So it's not surprising that you're seeing hedge funds of all flavors flock to the cryptocurrency space. There's a big rise in delta neutral strategies from almost no focus in the prior year. I think this is an acknowledgement by traditional hedge funds around risk and reward and risk return based on volatility. And I think the asset class, because the risk profile is so unclear, because there's so many different risks that are hard to quantify, and because the ecosystem is so nascent, I think a delta neutral strategy is where we're starting to see a great deal of traditional hedge funds flock. And I would just say from our experience here at Matrixport with our client base, both traditional hedge funds and crypto natives, the focus seems to be a large majority on crypto, on market neutral, even though the PwC reports it's about 30% strategies overall.
In terms of specialization of crypto investments, then are we going to see that going up as well? Is it just going to be a case of actually sort of increasing that exposure, but also focusing resources and trying to find the opportunities within that, allowing for greater focus from the hedge funds themselves?
Well, I think, just how you've seen growth across derivatives and DeFi in the last year kind of answers that question. The hedge funds are getting into the space. They're much less constrained than traditional fund managers, and they're willing to take on the security risks and the protocol risks, and are more apt to be comfortable with self-custody, which is required to get deeper into the DeFi space at this time, and is more comfortable with the counterparty risks of the players in the space who are typically not public. I mean, with Coinbase and Galaxy are the only 2 public companies in the space. Most people don't have audited financials, and the regulatory regimes in which they're incorporated are also not the G7 top tier jurisdictions. So you're already taking on that level of risk appetite, and so to see them go further afield in the crypto area specifically is not surprising.
And what does all this mean for crypto-specific hedge funds then? How does all of this interplay with one another?
I think crypto-specific hedge funds will continue to see adoption. I think we'll continue to see allocators look to find more professional, bigger AUM funds that have probably a good amount of traditional traders from the TradFi space before they start to allocate real amounts of capital. I don't, obviously with the market downturn, it's hard to see the growth in 2022 as we saw it in 2021, especially since some of the narratives of diversification have kind of fallen by the wayside, i.e. Bitcoin being an inflation hedge. So I think there's a huge interest in growth. The other thing we're starting to see is big traditional hedge funds, the ones that we would have top 10 in the TradFi world, getting into the space, but very slowly. They're all starting desks. They're all doing tons and tons of research. Much more research than many of these smaller traditional crypto native hedge funds would be doing. So it's hard to tell what the timing is. But these hedge funds are very opportunistic, and with the global macro backdrop and the more recent comments from the Fed at Jackson Hole, the it's hard to escape that crypto is a risk asset, and this isn't the best environment for risk.
All right, Anthony, thanks so much for joining us today. That is it from us for this episode. Like and subscribe to this video for more content like it, and let us know your thoughts on what's happening in the comments.